If you give me a few minutes of your time, I will teach you how sophisticated investors gain consistent returns in the long run by using this simple yet powerful financial concept of diversification. How do you feel when you see this chart? Does it feel like being on a roller coaster with uncontrollable ups and downs? Does it make you wonder how anyone gets consistent returns when investing? What's their secret? Hey champ, today I'm going to explain the financial concept of diversification, how it works, and how you can use it to achieve more consistent investment returns. Have you ever heard the phrase, "Don't put all your eggs in one basket"? What does it actually mean? Let me first explain the concept of correlation and volatility, as these are key to understanding diversification and the phrase, "Don't put all your eggs in one basket." Let's start with a simple example. If we have a lemon tree and an apple tree, and each tree every month grows and yields fruit. In this first example, the two fruit trees have positive correlation. Correlation is the relationship between two variables, such as the lemon tree and the apple tree, and the fruit yields. Since both are increasing in the same periods, this has a positive correlation relationship. Correlation is not causation, as there might be another variable such as the weather, which can be causing this relationship. But we observe in this example, there is a positive correlation between these two variables. The spread between the highest number and the lowest number of the fruit yield is the volatility. The higher the spread, the higher the volatility. If we look at the average yield of the lemon tree and the apple tree together as a portfolio, we can see that the shape is the same as the individual fruit trees or assets. There is still a bumpy or unsmooth movement in the yield of the fruit, so the portfolio still has inconsistent returns. So if both assets have positive correlation with one another, adding them together in a portfolio will continue to bring inconsistent returns and high volatility. In the next example, the lemon tree and the apple tree yield have negative correlation. That is, when one fruit tree yields more fruit, the other one yields less, and vice versa. So the direction of the return is opposite for each other. If we look at the average of the portfolio, the two assets combined, we can see the shape has become smoother. The portfolio spread has narrowed and the volatility has become lower. Since in this example they are perfectly negatively correlated, that is, they move in the exact opposite direction of each other, the ups and down movements have been offset and achieve more consistent returns. If we can find assets that are negatively correlated with each other, they can offset the risks and give us more consistent returns. So in this example, the volatility has decreased and the portfolio has more consistent returns. In the real world, it's hard to find assets that are perfectly negatively correlated. Most of the time, assets are uncorrelated. This means they don't move up or down the same for one movement in a particular direction. Things tend to move in multiple ways, and there may be no pattern in the movements. This example shows 6 uncorrelated assets, and it looks quite messy, with no real pattern of directions. This is much closer to a real life example. What we can observe is that the volatility of the fruit yields is within the 0 to 5 spread, and that the spread is quite wide. and hence the individual assets have a quite high volatility. If we look at the average of the portfolio, the sum of the yield of each of the fruit trees divided by the number of fruit trees, which is 6, we can see that the spread of the portfolio has narrowed between 1 to 4 from the 0 to 5. So the portfolio has a lower spread and from the highs and the lows of the fruit yields, and hence lower volatility. Since the spread has been lowered, the portfolio returns have become less bumpy or more smooth and hence more consistent. If we look between the 2 to 3 spread, we can see most of the fruit yields are within this range, which is close to the average. So looking back at the individual assets and the initial mess, if we look at the average of the portfolio, the sum of the yields of all the fruit trees divided by the number of fruit trees, we can see that the spread of most of the returns are between the 2 to 3 range. The spread of the portfolio is more narrow and most of the returns are within this spread of the 2 to 3 range. This slide shows it a lot clearer. We can see the average returns together with the individual assets. This shows the volatility of the portfolio is less than the volatility of the individual assets. We can also see the returns of the portfolio moves to the average of the yields of all the fruit trees. A few of the returns are above and below the average, but over time, we expect to be close to the average of the long run returns. As with the earlier example of the negatively correlated assets, having uncorrelated assets also benefits from diversification, as the ups and downs are offset by each of the other uncorrelated assets, as the returns are expected to move to the average of all the assets. This is the power of the diversification concept. Over time, we expect the assets to offset each other, lower the volatility and risk of the portfolio, and give us more consistent returns over time. There will be some outliers, but if we look at the whole period, not just a point in time, we expect the return to be close to the average return of the individual assets combined. So how do we apply diversification? To use diversification, you need to hold uncorrelated or negatively correlated assets together in a portfolio and hold assets for a long period of time. How do we do this in practice? The simplest way to build a diversified portfolio is to start with an index. Let's look at the common US index, the S&P 500, which holds the top 500 companies in the US. If we look at the performance over time, we can see the positive and negative returns of the S&P 500 through time. The S&P 500 has achieved a geometric average or time-weighted average return of 7.1% over the last 150 plus years. So if you held the S&P 500 through time and not tried to time the market, you would have achieved a 7.1% return per year. Although there have been some down years, there have been more up years to offset the down years. If we look at the returns another way, we can see which are the most common spread of returns, with a lot of the returns between 0 and 10% as the average. The shape of the returns looks like a bell shape, which is a reference to a normal distribution. This shows how the returns have become more consistent and the expected returns move towards the long-run average over time. Now, the technical reasons why diversification works is because of the following concepts: the law of large numbers, central limit theorem, and modern portfolio theory or mean variance analysis. These are quite technical and mathematical financial concepts, but if you're interested in them, I can cover them in more detail in another video. Let me know in the comments if you're interested. The benefit of diversification is it reduces the volatility and risk of the portfolio. It gives you more consistent returns, and the portfolio will move to long-run averages if held for long periods of time. So how to use diversification? You need to hold multiple types of assets such as equities, fixed income, and property. And within each of these assets, hold different types such as technology, consumer, financial, global, and domestic as examples. Holding indexes such as the S&P 500 is an easy way to gain access to a diversified equity portfolio. Hold assets over time. Buy and hold for long periods. Don't try to time the market. In the early example of the lemon tree, if you sold and replaced the lemon tree during a bad yield period, you would lose out in the future good yields. Don't make rash sales of low-performing assets. Think of your portfolio as a whole, with all your assets together when making changes in your investments. So don't put all your eggs in one basket, or don't put all your treasure in one chest, or don't rely on one type of investment to build your wealth. Whether that's a high yield savings account, a favorite tech stock, a property, a business, or even cryptocurrency. Diversification is key to building wealth. By spreading your risk and return in multiple assets, which would reduce your risk and give you more consistent investment returns. By having multiple investment assets, you'll reduce your risk and smooth your returns over long periods of time. You won't be reliant on one type of asset to build your wealth, and the investments can offset each other to give you more consistent return. Let me know if you found this helpful in the comments and give me a thumbs up if you did. Thanks for your time and attention, and until next time, keep being a champ in your financial journey. Cheers.